The S&P 500 is up 76% over the past 3 years, and AI stocks like Nvidia have skyrocketed more than 1,300% since the beginning of 2023. That begs the question, are we in a stock market bubble? Look, when you see a handful of massive tech companies driving almost all the gains, and you hear the whispers of irrational exuberance again, it's only natural to get nervous. It reminds me of the 2000 dot-com bubble and the 2008 financial crisis. Today, we're going to look at the 3 biggest red flags, the valuation indicators that scream overvalued. But equally important, we're going to look at the fundamental reasons why this time might actually be different. I'll end it with a clear strategy for the long-term buy and hold investors like myself, because panic is never a plan. If you look at the historical data, the market today is priced at levels that have almost always preceded periods of very low future returns, or even a major crash. There are 3 indicators that paint a picture of extreme valuation. The cyclically adjusted price-to-earnings ratio, or CAPE ratio, smooths out corporate earnings over the last 10 years, adjusted for inflation, to give a clearer picture of long-term value. The historical average CAPE ratio for the S&P 500 is typically around 17.6. We are currently sitting at a CAPE ratio near 39.51. A CAPE ratio this high has only been reached twice in history, during the lead up to the 1929 Great Depression and during the 2000 dot-com bubble. Historically, when the CAPE ratio is this elevated, the market has delivered significantly negative returns over the subsequent 10 to 20 years. Simply put, based on history, we are paying an extreme premium for earnings. The second indicator is the standard trailing 12 months price-to-earnings ratio, which compares the current stock price to the previous year of actual earnings. The TTM PE ratio for the S&P 500 is currently sitting around 27.88. The long-term average is closer to 16 or 17. This metric suggests that investors are willing to pay nearly $28 for every one of earnings, which is one of the highest multiples on record. This is a sign of intense optimism, perhaps too much optimism, about the near-term future of corporate profits. The third indicator is the Buffett indicator. It was named this after Warren Buffett famously called the market cap to GDP ratio as probably the best single measure of where valuations stand at any given moment. It compares the total value of all public US stocks to the country's gross domestic product. The historical fair value is a ratio of around 100%. That's often considered fair value. The current reading is hovering around 217%. The current value of the stock market is more than double the size of the entire US economy's annual output. This level is significantly higher than the previous extreme peaks, suggesting a profound disconnect between market optimism and real economic activity. In summary, the traditional valuation metrics are flashing bright red. If you're a financial historian, you have every reason to be nervous. However, the world isn't static, and history doesn't always repeat itself. There are 3 powerful arguments for why these valuation metrics might be permanently reset, justified by a new era of growth. The transformative power of artificial intelligence, AI, is the biggest counter-argument. The current market concentration is driven by a handful of mega-cap tech companies who I like to call the AI enablers. The growth projections for AI are just not incremental, they are transformational. McKinsey estimates that generative AI could add up to $4.4 trillion annually to the global economy. If a small group of highly profitable companies can fundamentally rewrite their cost structures and revenue potential using AI, their higher valuations are justified. Their earnings today are a poor measure of their earnings potential in a fully AI-integrated world. And unlike the 2000 dot-com bubble, where many high-flying internet companies had 0 or negative earnings, today's market leaders have robust cash flows, strong balance sheets, and proven business models. The high PE is based on real profit, not just hopes and dreams. The second argument is what I like to call the lower for longer interest rates, or the discount rate. A stock's theoretical value is the present value of its future cash flows. When the risk-free rate, which is the rate on US Treasuries, is lower, those future cash flows are discounted less, making them worth more today. While the Federal Reserve has raised rates not so long ago, they're starting to lower them again. The long-term, low interest rate environment that has persisted for decades suggests that central banks may not be able to hold rates high indefinitely. If the market correctly anticipates a long-term return to a lower rate environment of around 3%, the higher PE ratios are mathematically justified. Low rates make a 28 PE look less extreme than it did when the risk-free rate was 6 or 7%. The final point is global earnings and US market dominance. The traditional indicators like the CAPE ratio and the Buffett indicator primarily look at the US economy, but the S&P 500 companies are global empires. Roughly 40% of the S&P 500's revenue comes from outside the US. The Buffett indicator, for instance, only compares market value to US GDP. It does not capture the vast, growing international revenue of these companies. The US market has also become the safest, most liquid home for global capital, which drives prices higher, separate from domestic growth. This safe haven premium fundamentally elevates US stock valuations above their historical norms. So, having said all that, where does that leave you, the long-term buy and hold investor? Should you sell everything and hide under a mattress? Absolutely not. The greatest danger in investing is trying to time the market. Missing even a handful of the market's best days, which often happen right after the worst days, can completely derail your long-term returns. Here's the simple 3-point strategy for investing in an expensive market. Point 1, don't try to time the top. Invest continuously. Stick to the core strategy of dollar cost averaging, DCA. Continue to invest a fixed amount of money on a fixed schedule. When the market falls, your fixed amount buys more shares. When the market rises, your returns compound. This is the ultimate defense against high valuations. Point 2, rebalance and diversify. If you've seen incredible gains from the mega cap tech stocks, your portfolio is likely overweighted in that area. It's not about selling everything, it's about trimming your winners to bring your portfolio back to its target asset allocation. Consider diversifying a portion of those profits into lower valued sectors, international markets, or other asset classes like fixed income to reduce concentration risk. I posted a video recently on what I think are the ideal mix by age. Point 3, focus on quality and time. In a period of high valuations, quality matters more than ever. Focus your investments on companies with strong balance sheets, high free cash flow, and a clear path to generating sustainable earnings. The very companies most likely to capitalize on the AI revolution. Most importantly, lengthen your time horizon. The market may deliver weak returns for the next 5 years, but for the investor with a 10, 15, or 30-year outlook, the long-term power of compounding remains the single greatest force in finance. The market is expensive. It is risky, but a potential bubble is a long-term risk, not a short-term panic button. Stay calm, stay invested, and let the compounding work for you.